Hi. Let's learn about the double declining balance, DDB, depreciation method. The double declining balance depreciation method, also known as the reducing balance method, is one of two common methods a business uses to account for the expense of a long-lived asset. The double declining balance depreciation method is an accelerated depreciation method that counts as an expense more rapidly. Similarly, compared to the standard declining balance method, the double declining method depreciates assets twice as quickly. The declining balance method is one of the two accelerated depreciation methods, and it uses a depreciation rate that is some multiple of the straight-line method rate. The double declining balance method is a type of declining balance method that instead uses double the normal depreciation rate. Depreciation rates used in the declining balance method could be 150%, 200%, double, or 250% of the straight-line rate. When the depreciation rate for the declining balance method is set as a multiple, doubling the straight-line rate, the declining balance method is effectively the double declining balance method. Over the depreciation process, the double depreciation rate remains constant and is applied to the reducing book value each depreciation period. As a hypothetical example, suppose a business purchased a $30,000 delivery truck, which was expected to last for 10 years. After 10 years, it would be worth $3,000, its salvage value. Under the straight-line depreciation method, the company would deduct $2,700 per year for 10 years, that is, $30,000 minus $3,000, divided by 10. Using the double declining balance method, however, one would first calculate the straight-line depreciation as 1/10 years of useful life equals 10% per year. They would then double the SLDP, 10% x 2 equals 20%, and thus deduct 20% of $30,000, $6,000, in year 1, 20% of $24,000, $4,800, in year 2, and so on, stopping when the book value equaled the salvage value. Accelerated depreciation is any method of depreciation used for accounting or income tax purposes that allows greater depreciation expenses in the early years of the life of an asset. Accelerated depreciation methods, such as double declining balance, means there will be higher depreciation expenses in the first few years and lower expenses as the asset ages. This is unlike the straight-line depreciation method, which spreads the cost evenly over the life of an asset. Both DDB and ordinary declining depreciation are accelerated methods. The difference is that DDB will use a depreciation rate that is twice that the rate used in standard declining depreciation. DDB is ideal for assets that very rapidly lose their values or quickly become obsolete. This may be true with certain computer equipment, mobile devices, and other high-tech items, which are generally useful earlier on but become less so as newer models are brought to market. Here are 3 key takeaways. 1. The double declining balance, DDB, method is an accelerated depreciation calculation used in business accounting. 2. The DDB method records larger depreciation expenses during the earlier years of an asset's useful life, and smaller ones in later years. 3. As a result, companies opt for the DDB method for assets that are likely to lose most of their value early on, or which will become obsolete more quickly. Hope this would help. Thanks for watching.